All right, guys, Happy New Year. Hope you had a great weekend and a quiet celebration, as we should be doing. Going to start off today talking about cryptocurrency, as we had some crazy movements in Bitcoin, Ethereum, Dogecoin, among others as well. I mentioned last week that a good way to play crypto with good asymmetry of risk is trading equities like Riot Blockchain or Mara, for example, using equity options. So the reason why it's more effective to manage your risk doing this is because, for example, if you want to buy Bitcoin right now, even if you're buying a Satoshi and you're paying, 34 grand for the equivalent of one Bitcoin, right? To make double your money, you need to go to about $68,000, right? So with Riot Blockchain, for example, which actually mines cryptocurrency, they're already at around 17 bucks. I'd imagine tomorrow they'll open up at around 20 probably, given Bitcoin's run the past few days. And so trading options on Riot or Mara, for example, would be much more effective. And I'll show you guys what I mean by that, right? So let's say, for example, that you believe that Riot Blockchain will go to 30 bucks in the next 6 months, right? Which would coincide with Bitcoin probably rising to around 45K, right? So why not look at a position longer term, perhaps, and maybe look at June, for example. And also note that the implied volatility is very high here. So the premiums are very expensive. You don't want to be buying call options or put options just straight away. You want to be using spreads to offset your risk, right? Because you offset your time decay, which is theta, and your volatility decay, which is your vega, right? So for example, let's say you're bullish into on Riot into June expiration. You can look at, for example, buying the $20 call option. Let's say, oops, one sec. Let me just go back. Strategy builder, right? So you buy a $20 call option, right? You pay about $7.30 for that. And then you can sell, for example, the 30 strike call against it, right? Now, because of the expensive premiums out of the money on Riot, you're pretty much paying roughly $1.30 or so, maybe $1.40 midpoint for a 10 wide spread. So your upside is $8.60. Your downside is $1.40, right? So you have pretty much asymmetry of risk of 6.14 to 1, right? So you have upside of 6 times your money, basically, right? In order to achieve the same asymmetry of risk with Bitcoin, it would have to go to about 34K times 6, 204 grand per coin. So this is a much safer way to trade crypto than buying the actual asset itself. On top of that, you can trade it in your Roth IRAs, your tax-free accounts if you're in Canada, for example, and you have tax benefits there as well, right? So not a bad idea to trade Riot or, for example, Mara using spreads, right? Here's Mara, right? And again, the same idea can be applied on a longer term thesis where you're risking a smaller amount of capital for potentially a much larger upside. So for example, with Mara, you might buy, again, the $15 call option perhaps, and sell the $20 call option perhaps, right? And over here, now your risk would be around midpoint would be approximately, be risking about 60 cents or so midpoint, and your upside would be $4.40. So again, you have 4.4 over 6, sorry, 4.4 over 0.6. You have 7.3 times your reward in risk, right? So for every unit of risk you have 7 times potential reward, right? And again, for you to achieve that kind of asymmetry of risk on Bitcoin, for example, it would have to go to like 200K plus in the next few months to achieve that same return. So you understand that with Bitcoin, you're risking, for example, 34K for one coin for who knows what return. Whereas here, using options on Mara or Riot, you can risk a fraction of that in a Roth IRA, for example, which is a tax-free account, or in a tax-free account in Canada, and that will give you taxable benefits as well, and very favorable asymmetry of risk, right? So some ideas on crypto. Also to note as well, which is interesting, one of my friends pointed this to me. The top 10 countries in the world right now that are trading Bitcoin are actually nations that have dictatorships, right? So I think it's actually 5 of them that have dictatorships right now. The list is over here. You can see Ukraine, Russia, Venezuela, China, Kenya, US, South Africa, Nigeria, Colombia, and Vietnam, right? So interesting to see this data over here. Links over here if you want to cut and paste it, obviously, or freeze frame the video and watch and go to the link after and read it yourself. You can as well. Just thought it was kind of interesting there. Next, we're looking at right now. I'm going to pull up the chains for some weed stocks because again, this week we have some big events occurring, right? So Tuesday we have the Senate vote, and if the Democrats win, or if they split actually, because Kamala Harris is a Democrat VP, they'll actually take the Senate, right? And so that would mean they would control the House and the Senate, and that would, and historically speaking, when one party controls both, the markets do very poorly. So keep that in mind into Tuesday this week, because trading could be very choppy as we approach that event. So be positioned pretty neutrally. If you're pretty bullish and the Dems do win, you may see a pretty sharp pullback. I'm talking about a 10 to 15% pullback in the broad market, which I think is overdue. It also coincides with my overall thesis that basically profit taking should occur in the first couple of weeks of this year because the market held up into the last week of last year, right? So I think we're going to see a pretty choppy first few weeks of January this year. And looking at some stocks that may benefit if the Dems win the Senate, right? Weed stocks. So again, you have your CGC, right? Canopy growth, and you have your Aurora Cannabis as well, right? They're both weed stocks, obviously. And again, given that this is an option-centric discussion, we can look at it through the lens of options, right? So looking at, for example, and again, I don't advocate trading weekly contracts because they're too binary in nature. I recommend going out at least a month minimum. So if you're looking at, for example, Aurora Cannabis, you might look at the March or February OPEXs and trade spreads out of them again as well, because the IV is still pretty high overall, even though the HV is 126% and the IV is 103%, right? There is still room for it to fall down as well, right? So looking at Aurora Cannabis, for example, you might look at, for example, the $10 call option for February OPEX and sell against that the $14 call option, right? And again, now you have a risk of about 53 cents or so to make a maximum profit of 4 wide on your spread, minus 53. So your maximum gain would be about $3.47, right? So not too bad overall. Your break even would be $10.53 on the trade, obviously. And again, I expect some pretty rapid movements on solar stocks as well as weed stocks if the Democrats take the Senate, right? So the same idea can be applied to Canopy growth as well. Pretty much just look for, look at the chart, figure out what your target upside would be. And you can even price out the expected moves, for example. So you might look at, April, for example, and say, okay, well, the expected move to the upside on Canopy growth is about $8 in one direction. So upside is 33. So then I might look at, for example, buying the 25 strike call option over here, right? And selling this one over here, 32.50 strike over here, right? And so over here, you're risking a bit more, obviously. It's a higher price stock. You're risking about $2.10 approximately. Your break even is 27.10 because it's your lower strike plus your debit paid. So 25 plus 210. And your maximum profit would be 750 minus 210, which would be $5.40, right? So again, some interesting ways to play this possible Democratic win of the Senate, obviously, because you may see weed stocks and solar stocks pop up as well. So that's what I'm talking about for weed stocks. Someone also mentioned TRUL as well, which is a penny stock. I don't know much about them, but they mentioned that it would be a good play for weed stocks. So here's a chart right here. Again, I don't really know much about them, so do your own research on this, obviously. But here's the chart for the past year. And then looking at First Solar, which is my favorite solar company, they've been on a bullish run all year. They broke up to about 110 or so a couple weeks ago, pulled back a fair bit. I do expect them to push back about the 110 area, assuming that the Democrats win the Senate. And if that occurs, you're going to want to look at probably doing, again, some call spreads on positions there, right? So let's pull up First Solar over here, right? So the Implied volatility is pretty reasonable right now. It's roughly the historical, so it's pretty much flat. That being said, if you do want to mitigate your risk, you still want to use spreads, because obviously if the Democrats don't win the Senate, then solar stocks may pull back abruptly as well, right? So again, looking at for this week, the expected move for Friday is about $6 in one direction. So you're looking at a higher area of 106 on First Solar and a lower area of 94. If you want to play the upside, again, you might want to buy a $100 call option, for example, and perhaps sell the 105 strike. And there you're risking about $1.40 or so for maximum profit of $3.60, right? So good asymmetry of risk overall. You're pretty risk controlled in position, and your break even is only 101.40, right? So pretty reasonable as well, right? There's also SolarEdge as well, and the TAN ETF. So TAN is the solar ETF, right? Or clean energy ETF. And it's been running like crazy all year as well. Here's the chart. I'll pull it up. So looking at it over here, you can see again, massive run up. It was at about 20 bucks back in March. It's at 103 now. Again, I expect it to go to about 110 if the Democrats win the Senate, right? So same idea here, same idea with SEDG, SolarEdge as well, right? They've been on a rampage as well here, and a bit of a pricier stock. So you might want to trade a TAN or First Solar instead, right? Looking past that, looking at the EV stocks. So we had some big news this weekend. We had NIO reporting their sales figures. They had some good numbers there. Same with Tesla. They missed marginally by about 450 cars of production. I think that's actually very priced in right now on Tesla. So I do think you're going to see a pretty nice pullback in the next few weeks, not only because of the event, but because of profit taking, right? So we see that the market ran up high to the all-time highs on on Thursday rather, in anticipation of the figures being released. Now they're out, and I expect a pullback to around the 650 area this week, possibly down around 600 in the next few weeks, right? And that would be an area I'm looking at for support right around here. If it breaks down below that, then next area of support is around 450 or 400 even, right? So not a lot of support in this area over here. If it breaks below 600, look up below, right? And the valuation is very, very rich right now. Like they're priced to perfection and beyond. So you need to be very cautious in buying Tesla right now at these elevated levels, right? Think about your asymmetry of risk. You're paying about $650 billion for a corporation that makes 28 billion in revenues. And even if they ramp up their revenues, year over year by 100% for a few years, they're still pretty much valued where they should be right now, assuming that, right? So they have to perform very, very well over the next few years just to justify the current valuation, right? And on top of that, let's say that in 10 years, they're worth $6 trillion, right? That means that you have possibly 9x return in the next 10 years on Tesla, whereas your downside is probably more than 50% right now, given that they're worth $640 billion, right? Or 650 billion, sorry, right? So that's for Tesla. NIO as well was interesting, right? And actually, you know what? I'll actually delve into Tesla a little bit first on option ideas, right? So looking at this coming week, the expected move on Tesla is approximately, it's 6.6%. So upside is 752.47. Downside is 658.87. And you have a upper potential move of 9%. So upside would be 769.62. Downside is around 640 or so, right? So looking at the option chain over here for the week ahead, again, playing weekly option expiration is super risky. I wouldn't really do that. But if you were inclined to look at, for example, next Friday's expiration instead, you might find a nice put spread. For example, you might buy the $700 put over here and sell the 650 put against that position right there. It'll give you about 1-to-1 risk reward roughly, right? So you're risking about 18 or so to make $32. So almost 2-to-1 risk reward actually, right? So not too bad. Your break even is 700 less 18, so it would be 682. That's your break even price on the trade, right? Obviously, if it breaks below 650, you're making max profit there. Your break even is 682. If you are bullish, again, I don't know why you would be at this juncture. You can obviously play the opposite way and just go with the call side. You might say, you know what, I'm going to buy for example, 700. Actually, wait, right now the price is pretty rich on the call side due to skew. So let's see. Yeah, the asymmetric risk isn't that great overall out of the money. I mean, if you wanted to go out of the money, you could buy, for example, a 7050 strike call option, sell the 780 strike perhaps, and then you're risking like about $6 roughly to make a maximum profit of 24. So you have 4-to-1 risk reward there. Your break even is 756. Again, it's within the upper possible move for the week ahead, right? So not a bad idea. But I'm overall bearish on Tesla right now. But again, to each their own. If you're bullish, use a bullish strategy. If you're bearish, use a bearish strategy. Manage your risk. Be aware that it could plummet, $100 in the next couple of weeks, or it could pop again as well. I think it's gonna do the former versus the latter, right? So I'd be targeting the area right around 600 to 550 perhaps over the next few weeks. Next up, we're looking at NIO as well. So NIO had some interesting numbers this week as well. They had good sales figures as well. And we have actually NIO Day next Saturday, January the 9th. So that occurs after OPEX for this coming week. So you won't want to play the following week's OPEX. You probably going to want to play it longer term if you are bullish on NIO. I know a few of you guys are. So look at it. Look for it to break above around 55 or $56 or so and push that all-time high if they have some interesting news on Saturday next week. But prior to that, the option premiums are very rich right now. So if you look at the premiums on NIO, you can see that, for example, this coming Friday, the expected move on NIO is right now it's 11%. So upside is 54.33, downside 43.55. And the potential move is 14.4%, upside 56, downside 42 roughly, right? So looking at that, with that in mind, you might think, you know what, I want to trade a call spread again, because again, the IV is 107% roughly, right? So it's pricing in almost 7% moves every single day. So we should see on average every day this week, NIO move by about 7% intraday, right? That's what this is telling us right here. So looking at bullish positions, you might do, again, a call spread if you're bullish, a put spread if you're bearish. I'm going to probably stay away from this and not really touch it at all. I prefer to wait for the IV to die down and for the information to be released on NIO Day, then trade it beforehand, because obviously you have to be correct directionally. Even if you're managing your risk well, if you're wrong directionally, you're just going to lose, right? So premiums are very rich again. For this Friday, you have a roughly expected move of about $6 in one direction. Next Friday, you have even more, right, because of NIO Day. So next Friday, the market's pricing in a move of about $9 in one direction, roughly, right? So upside would be approximately 58 for next 58 for next Friday. Downside would be about 40, right? And one way that I would play it though is, given that the IV is so elevated right now, I was talking to someone else about doing this, which is selling cash secured puts way out of the money, because even if you price out the expected move for February OPEX, right, you have an expected move of about roughly $15 in one direction from here, right? So downside is around 34, upside would be around 64, right? So looking at, or sorry, downside would be 36, sorry, right? Upside is 64. So downside, looking at that area, right? Again, pulling up the chart, you can see that there is some support around 40 area right over here, right? Not a lot of support, but there is some support over here. If it breaks below 40, look out below, because at that point you can go all the way down to around 30-ish, right? And if it breaks below there, then you're looking at pretty much 20 area, right? But again, I think it'll stay above the 30 area, possibly drop below 40, depending on the information that comes out. But as I mentioned, playing it with cash secured puts is not a bad idea, because there's a lot of premium to be had out of the money. So if, for example, you're selling a 33 strike put option that expires in a month and a half, you're pulling in roughly $1.10 premium, and you have to be okay buying the stock at 33 less 110 or so, which means your effective price would be 31.90, right? That's a good way to buy the stock at a cheaper price, assuming you want to own it, right? If you don't want to own it, then don't do the strategy whatsoever, right? If you want to trade a bullish position, for example, go with a call spread. If you want to do a bearish position, do a put spread, for example, right? So just some ideas there. Obviously, I think that the most reasonable way to play it would be probably using February OPEX and buying, for example, the $50 call option and selling the $60 call option against it, right? because now you have risk of about 285, break even is 52.85, and you have upside of around $7.15. So your asymmetry risk is pretty favorable overall. Even if it were to pull back prior to this expiration, what you could do on the pullback after the event on the IV crush is buy back your short contract over here, right? And keep this open-ended over here, because this one will actually lose more value on the pullback than this one will lose, right? So just some ideas there on NIO. Obviously, there's XPEV as well. They had a big pullback last week, and here's a chart over here. So we have XPEV. They pulled back below 40 temporarily last week at 37 area. They stopped right here, pivoted back up, and closed at 43.25 on Thursday close, right? So again, over here, we're testing out that support area, which is down at roughly 37.38. If that breaks down, then 30 is in reach for sure. And upside again, I don't think you're going to see it push back above here again. This was kind of a squeeze over here. I think it's going to be very tough for it to push back above 55 again. So obviously trade cautiously on XPEV. Same ideas can be applied, as I mentioned, on NIO to XPEV as well, and also Automotive as well, which is another Chinese EV too, right? So same idea over here, similar pattern formation as XPEV. You can see over here that little double tap at the bottom over here, where we found 2 wicks and tweezer back up. So same idea, but again, I don't think you're going to see it push back above this area anytime soon at all. So it'll probably be range bound between 37.50 and 27.50 for the next few months before it has any kind of big movement in one direction, right? So that covers Tesla, XPEV, NIO, and LI, right? Next, we're talking about one sec. We're talking about LAZR, VLDR, Quantumscape, and BLNK. So these are corporations that actually make LiDAR. So LAZR, which is Luminar Technologies, and VLDR, which is Velodyne Technologies, right? They work on LiDAR technology for self-driving cars, right? So looking at these positions, you have LAZR, right? There we go. So you can see again, they SPAC'd over here. They popped to like 47.50 and change, pulled back down to 22.50 roughly, and they pop back up over here again, right? So I expect a lot more volatility in these names, but that doesn't mean you can't trade the options on them, right? Because there's a lot of premium to be had. And so one strategy that's kind of fun to trade is buying equity and selling deep in the money covered calls against it. So looking at, for example, LAZR, the current price of the stock is around 33.80 right now. If you're buying equity in it, you can sell deep in the money covered calls, even a month out perhaps, right? Looking at the 25 strike right now, you can sell these for about 10 bucks almost, right? So your break even on the trade is roughly 35. If you buy the equity right now at 33.80, you're pulling in like $1.20 of extrinsic value pretty much over the next month and change. It's kind of like the equivalent of selling a cash secured put. If you want to do that instead, you could sell obviously the 25 strike over here for around $3, and then effectively you're going to own the stock for around 22 bucks. But obviously, keep in mind this is a long-term play. I'm talking like 10 years. So if you are going to accumulate a position here, be prepared to wait and sit on it for a while, right? But keep in mind that also the covered calls are very, very rich. So there's a lot of premium to pull in, right? Like if you buy, for example, the equity at 33.80, you can sell a covered call a month out and pull in more than 10% on the 40 strike, right? So you have upside on the equity of basically $10 over the next month and a half, which is a profit of about 33% over the next month and a half, right? So you have a lot of upside, and your break even would then be around 30 bucks on the nose. And if you were to sell premium against your position of 100 shares every single month, you're cash flowing between 10% and 15% perhaps every month, right? Because keep in mind for earning reports, you're going to see much higher premiums as well, right? Looking at Velodyne next, which is VLDR, a very similar idea around that. However, it is a cheaper stock as well. So VLDR, and also valued less than Luminar. So VLDR. So you can see they're at around 23 bucks right now per share. Current valuation on VLDR is right now they're worth $4 billion. They have revenue of 77 million, whereas Luminar, which is LAZR, they're worth $11.7 billion, right? So they're worth around 3 times what Velodyne is worth right now. So I would prefer probably to invest in Velodyne versus Luminar. And again, looking at Velodyne over here at 23-ish, right? We can see the bottom was around 11 and change this year. So looking at Velodyne, let me pull up the option chain again. You can see that if you're gonna trade this, BLDR, there are cash secured puts that you can sell out of the money. For example, the $15 strike price for a month and a half out, you get about 75 cents over here. That means that effectively you're happy owning the stock at $14.25 per share, right? It would have to fall about $9 or so for you to be at your average price here. And what would happen is that over time, over the next month and a half or so, if it stayed above 15, this would just evaporate and you'd collect 75 bucks per contract, right? Obviously, if you want to trade the bullish side, again, given the elevated IV, you have to use call spreads here. Liquidity may be an issue though, because you can see that the spreads are pretty wide. If you're buying the 20 strike call option, for example, you're paying between 480 and 560. That's an 80-cent spread. That's pretty wide overall, right? You might want to do, for example, a 25-35 call spread instead. And there you're risking about $1.65 or so to make a maximum profit of $8.35. So your asymmetry of risk there is pretty damn favorable. Your break even is 25 plus $1.65, therefore 26.65. Not a bad idea or a bad way to play it. Again, assuming you're bullish on Velodyne, and it is still risky because it could pull back down to around like 18 bucks, for example, per share pretty easily. And that would leave you with a maximum loss on the position over here, right? Obviously, if you buy, a month and a half out, you have a chance to exit prior to expiration and salvage some of that, but it is still risky though, right? Next up is Quantumscape. So Quantumscape actually had a massive movement this past week or so. That's QS. They are a solid state lithium ion battery maker for EVs. And you can see that they had a massive run up to almost 140 per share. And then over the last 5 sessions, they've pulled back down to 74 and change. And actually Thursday after market close, they announced a secondary offering. So they'll probably pull back down to around 60 bucks, maybe even 50 bucks per share. But the problem with shorting QS via put options, as you will see in a second, is that the premiums are very, very rich, right? Look at, for example, the January 15th $60 put options right now, right? You're paying about $370 per contract, and that's to fall down to $56.30 for you to break even, right? Even the 50 strike, you're paying $1.50. This is only 2 weeks out, right? So it has to fall from 75 below 50 in the next 2 weeks for this to be in the money, right? So it reminds me a little bit of NIO Motors when it was back at like 80 bucks, for example, because it ran up very fast and it pulled back very fast as well. However, they do have very interesting technology overall, and they are backed by Bill Gates as well. So I do believe in the corporation longer term. But again, that's what it may be, just a longer term position versus a shorter term trade, right? That being said, looking at the premiums, a month and a half out, you can see that they are very rich. So for example, if you were to sell the 40 strike put option a month and a half out, you're collecting about $2.75 in premium, which means that it would have to fall by about 50% in a month and a half for it to be in the money, right? This is why it's kind of hard to short, because the premiums are too rich here. So similar kind of trade idea as NIO Motors when it fell down. However, there is no catalyst in terms of fraud, in my opinion, whereas NIO Motors is obviously not a very legit company, right? I think QS is legit, and longer term they'll do very well. But obviously the valuation is still pretty rich, because right now they're worth $17.3 billion right now, right? With no revenues yet. So keep that in mind as well. That was another EV battery maker as well. And the last one was BLNK, right? So Blink, I think it's called Blink. Where is it? It's called Blink Charging Corporation, right? So let me pull the chart there, BLNK. Similar chart. One sec. Here we go. It's pulling up here. Let's go with the 1 month. There we go. So they SPACed as well, and they shot up from $10 up to a high of 55 last week, I believe it was on Monday, and they pulled back since to 43. Again, downside is probably around, I'd say 15-ish. That's your downside area, which is your previous highs, right? Right around over here, approximately. So you got to be careful with this name, but there are rumors that someone like Tesla may acquire them. Who knows if that's true or not? I don't like playing on rumors whatsoever. I'm just mentioning the companies associated with EVs right now, like LAZR, Velodyne, Quantumscape, and BLNK as well, right? So looking at BLNK again, I wouldn't really play it, but just something to kind of be aware of, because there is some risk baked in over here as well, right? Next up, we're going to be looking at the names I think are going to be performing very well in the next few years. However, some of them have ran up pretty hard the last month or so, and those are the Crispr stocks, right? So we're going to start off with Crispr, CRSP, and I love this company. I think they're going to be a phenomenal win longer term. I think that at some point in the next 10 years, they'll be worth over $1,000 per share if they're not acquired beforehand, right? So this is actually one of my top bullish stocks for 2021. And my target for this year is $280 per share, roughly. That is a more a complicated discussion if I want to get into the valuation side of things. But either way, you can see that we had a massive shoot up from 110 all the way up to around 188 or so, or 186 or so. Nice little pullback over here. I think support might come around 140, so I'm gonna look to re-enter around 140 per share. There's also Editas as well, EDIT. They're currently valued at about, so Crispr is worth right now a valuation of 11.5 billion, and EDIT, Editas Medicine, is worth 4.77 billion, right? They also have more revenue as well right now, Editas does. So interesting to see that, because they have 91 million in revenues, whereas Crispr has 77 million in revenues right now and a larger net loss, right? So Editas, I think, might be a better play overall, but I am bullish across the entire sector. So I like Crispr, Editas, Intellia, and Beam Therapeutics, those 4 names. And I'll be spreading my risk across those 4 names over time. So Editas, for example, again, same thing, right? You saw it push. I mentioned it a few weeks ago in our session that it was going to explode. It was actually right over here when I mentioned that, and sure enough, next week it popped up to 65 or so. But I think that'll pull back right around to 60-ish, and that would be a decent entry point. Otherwise, looking at Intellia, NTLA, right? Same industry again as well. I'd be looking to get in here around 40 or so, right? So pull back to 40 would be a decent entry point. And again, if the broad market pulls back by about 10-15%, I would expect to see Crispr around 140, Edit around 60 or so, Intellia around 40 or so, and the last one is Beam Therapeutics, right? This one's, I think it'll pull back to around 60 or so right over here as well, right? And the problem with trading options on these names is the option chains aren't very liquid, right? So what I mean by that is that the spreads are very wide. So if you look at Crispr, for example, right, you can see that it has very, very wide spreads on their contracts because there's no open interest and almost no volume as well, even for monthly OPEX as well, right? So you can see monthly OPEXs, even at around numbers like 160, 155, 150, for example, there isn't that much open interest and the volume isn't very high either. And so you're seeing these very wide spreads. So for example, if you want to buy, the 160 call option, you're paying between 650 and 730 for a week out, right? Or for 2 weeks out, sorry, right? If you want to buy, for example, the 170 call option, look at that. Your bid is 285, your ask is 610. So again, my strategy is to buy the equity itself and then select covered calls against my position, right? That's what I've been doing for the past few months. I lost my position a few weeks ago, but I do want to get back into Crispr, and same thing with Editas and Intellia as well, right? So you can see over here again, no open interest, no volume, very wide spreads. It's hard to trade with options, right? So the way to get in possibly is either through a cash secured put, which may require some patience. So for example, if you want to buy Editas at $60 a share, you may put in a limit order for an ask price of like $2 perhaps on the $60 put option contracts for 2 weeks out. And if it goes below 60 by next Friday, then you're going to own the stock at $58, right? But again, these are longer term positions. They're not short term trades. Like you're not going to buy this and try and trade it to make, you know, $5-10 in a week. You want to buy this to hold it and make, you know, like, you know, 200, $300 per share in the next few years, right? That's the whole idea behind these names. So that covers the Crispr stocks. Next up, we have my bearish bets for the year, right? Which are starting with Snowflake. That's my biggest bearish bet for the year. And we have Snowflake. It's actually been breaking down dramatically. I'm in put spreads right now for February OPEX, the 300, 250 put spread for that expiration date. And it's looking pretty good for me right now. I'm already up about 100% on my position. But I do think it's going to break down to around this level of right around 225-ish in the next few weeks. And here's the kicker right now, guys, the big kicker right now. So in March, they, backing up a sec. So for their IPO, they actually issue different expiration dates for the lockup period, right? So in March, they're going to go from a share float of about 34 million shares, right? Current float is about 34 million shares to a float of about 340 million shares. So about 10x that, right? So you're going to see a lot of selling, I think, and a lot of downside in Snowflake. I think you're going to see it probably below $200 by March OPEX. I was conservative, you know, 300 to 250 area because, you know, I prefer to be conservative than be outlandish in my predictions. But again, I think you're going to see it go below 200. I'm playing it down to 250-ish, and for me, I'm happy with that. So I'm very bearish on Snowflake this year because they're very overvalued, right? They're worth right now $85 billion. They have sales of about $490 million, operating at a net loss of $400 million approximately. And on top of that, they're paying their CEO a bonus of $100 million every month. How can a corporation pay their CEO $1.2 billion annually in bonuses and they're only making $490 million? Right? Interesting idea right there. So I'm bearish on Snowflake, one of my top shorts for 2021 as well. Also, DoorDash.
Can I add something?
Yeah, of course.
So Nick is going to give you one side of it, but understand something about IPOs. It's all about supply and demand. Everybody's running through the door when it IPOs because they want to get a piece of it, right? But also remember, as people are running in, there are actually people who are running out. They're cashing out. Now, the markets say, well, guess what? You can't bamboozle retail investors. So we're going to lock up a period, right? So that lockup period is all these guys who are frothing at the mouth to unload, right? And that's what you have to remember. Now, whether the price goes up or down, news related that's separate. Just on the supply and demand side, anytime that two things happen, you have to know what the price is. When there is a secondary offering, the price will go to whatever the offering is. Naturally, it's a natural point of control, right? So, for example, on Nikola, they did a price offering, and the price offering was, I think, 38. The stock dipped to 38, right? Why would you buy the stock for, 38, private, if you could publicly get it for 36, right? So the price always deviates to that offering area, okay? And when it comes to IPOs and the lockup periods expiring, you have employees and you have early investors who have massive gains. They want those realized, right? If not all of it, a good chunk of it or a portion of it, right? They want to take some money off the table, right? But what happens is as the float comes in, well, there's got to be buyers. And if there aren't buyers, the price keeps going down, right? Because there's more supply than there is demand, right? The demand is usually at the IPO level, not at when the lockup is done. Okay, so now news is a separate factor, technical analysis is a separate factor. This is just pure supply and demand, right? And don't ever think that that's bottom line is supply and demand is what rules the market, right? News influences the supply and demand. Technicals influence the supply and demand, but everything that you're dealing with has to do with supply and demand. So when you know that there's an abundance of supply, why would you buy in front of it, right? So just think about that. You guys know there's going to be a crap load of bread. You're not going to stock up on it. You can get it whenever you want. You can probably get it on sale because there's too much of it, right? Same philosophy here. So this is why the short on snow makes sense, but it's also got to be timed around the lockup period. That's what I've got.
Awesome, Ashish. Really appreciate that. So what you said applies also to DoorDash and Airbnb to a lesser extent, obviously. But so that's for the March option expiration date. I went with the February OPEX because, again, if you notice in the option chain, you see that there actually isn't a March, there's only May. So I think that people will be selling off in anticipation of this event occurring. So it isn't too late to get in probably, right? I priced out the 250, 200 put spread for February OPEX a month and a half away, right? It costs about $11 or so in premium. Your upside is $39. So you have about 3.5 times your possible reward for every unit of risk, right? And your break even would be 250 less 11, so it'd be 239, right? Again, I think that it will plummet down to around 200-ish. I am very bearish on it because of the flooding of new shares coming in the market in March. And I think that a lot of people understand that. And so they're going to be selling out into that event. You can see that already in the last few weeks. I mentioned this a few weeks ago, actually, when it was around 380 a share. And it's fallen since then. It's fallen down by about 31% already in the last like 4 weeks or so, right? So I mentioned this same trade idea back in, I think it was in like early December, and this is what happened since then, right? So I don't think it'll be straight down. You may have some rallies back up to 300 and change, but I think you're going to see some resistance over at 300 now, and perhaps a consolidation area around here. But then into February, you're going to see it fall down to around this area right here, right? So same idea applies to DoorDash and to Airbnb as well. Obviously, less data to go on because they've only been trading for a few weeks now. But lockup period would also be 6 months from the IPO date. So you're looking again at 6 months from December 9th. So mark that in your calendars. If you go out January, February, March, April, May, June 9th, roughly, should be the expiration date, right? So looking at that far ahead, again, due to the rich premiums, you need to kind of hope it stays elevated in price as we approach June 9th expiration date, and or whatever that expiration date is after that expiration date, and then play it accordingly around that expiration, right? Same idea with Airbnb as well, right? ABNB, because these are very overvalued IPOs, right? Like Airbnb, for example, you're looking at them, right? They're worth $89 billion right now, revenues of 3.6 billion, operating at a net loss of $1 billion, right? And you look at companies like Marriott, for example, right? Was it Marriott? Marriott, here it is, right? So Marriott does revenues of $14 billion. They're profitable right now, marginally, obviously, due to COVID. But at the same time, they're worth $42 billion. So they're worth less than half the valuation of Airbnb. And yet they have 4 times the amount of revenue, and they're also profitable right now as well. And their balance sheet is healthier too, right? So you look at the valuations on these IPOs, and adding to what Ashish said, an IPO, the purpose of it is to cash out the initial investors, right? It isn't to allow the public to take part in the profiteering of the company. It's to allow employees, VCs, senior executives to cash their shares out, right? So if you're buying an IPO, you're playing a losing game at the onset anyway. It might work out longer term, like Facebook, for example, or Google or Amazon, right? But the newer ones are IPOing at absurd valuations, where it may take many years for the price to catch, for the valuation to catch up with the price, right? If that even occurs, right? So again, DoorDash and Airbnb are also big shorts, I think, for 2021 as well. So Snowflake, DoorDash, and ABNB, my top 3 shorts for the year ahead. Next up, we're going to look at Palantir as well, because Palantir I think is an intriguing opportunity here as well. So Palantir is they actually went public via a direct listing. So they chose not to raise money through going to the market, right? So by them going public, they actually didn't actually actually raise any cash at all through their direct listing at all. And I think that longer term, they are a great play on data, because they've been working on their software for the past roughly 17 years or so, and now they're focusing on sales. And as they branch out from just government clients into retail operations and other corporations as well, I think you're going to see them become a player kind of like IBM, or maybe even kind of like a Salesforce perhaps, right? So I think longer term, it's smart to accumulate shares. I have a small position right now currently, but I'm going to be adding to it over time, and I'm selling covered calls on it every month to pull in more premium and lower my cost. But looking at the option chain on Palantir, right? So if you want to own the stock, for example, at around $20 a share, you can look at the February OPEX, right? You can sell right now the $20 put options for February OPEX for $1.76 or so midpoint, right? That means that you'd be okay owning the stock at $18.24, right? Which is not a bad starter position. If you get assigned at that point in time, you can look at selling covered calls out of the money. Again, I would target the 30 strike area over time, because it may sit between 20 and 30 for a while before breaking to the upside, right? But I do think that you're going to see it play out a lot like Salesforce, in that it'll grow gradually for the first few years, and then it'll probably skyrocket in the next from about 2024 to 2026 or so, right? So in about 4 or 5 years, you might see it at around $200 a share roughly, I think, based on looking at Salesforce's growth levels over the past years as well, and based on understanding the market that they're in right now, right? I think it's in its infancy right now, and that it will grow dramatically over the next few years as the globe becomes more data centric overall. And on top of that, they're backed by Peter Thiel, who founded PayPal, and everything he touches pretty much turns to gold, right? He invested in Facebook early on, he founded PayPal, and now Palantir as well, right? So just some ideas on Palantir. Again, if you're bullish shorter term, again, call spreads are the way to play it, and there is good asymmetry of risk going out to the February OPEX. If, for example, you buy the 25 strike call option, you sell the 30 strike call option against it, right? You're pretty much risking right now $1.33 approximately. Your break even is 133 plus 25, which is 26.33, right? And your maximum profit would be 5 less 133. Therefore, it would be $3.67, right? So you have almost 3-to-1 risk reward on that position there. I think it's a pretty realistic position overall, because I think it'll bounce between 20 and 30 for the next few months before it has some kind of news that'll cause it to go up, right? I think that they'll have more contracts being released in the next 6 months or so, and as that news comes out, you're going to see the price elevate over time, because their current guidance for this year is $1 billion in revenues. As we see new contracts hit the headlines, we may see the stock price elevate as well, because obviously, if we can math out that they're going to beat their estimates of $1 billion in revenues, we know that they should be valued at a higher valuation as well, right? That's a Palantir idea, and one of my strong longs for the year ahead. My best asymmetry of risk play for the year ahead would be probably Virgin Galactic, right? SPCE, just because they have such great upside, and the downside I think is pretty nominal overall. So again, where's the chart? The chart is over here. SPCE. You can see that over the past year or so, they've kind of traded in this range for the most part between 15 and like 2250 for most of the year. They broke above that range, and now support area is right around 2250 now. So previous resistance area is now support, and it's going to bounce probably between this area right here and this area over here. Obviously, they're supposed to reschedule their test flight, which was pushed back again a few weeks ago after they aborted it. And I do think that this has potential to push to around $50 in the next year or so. So obviously that would be a double up on the equity itself. And looking at the option chain, you can see that for the week ahead, we have an expected move on Virgin Galactic of 7%. So the upper area would be 25.37 for the week ahead, downside 22.09. And the potential move for the week ahead is 9.7%, 26.04 upside, 21.42 downside. So looking at the option chain and seeing that the IV is actually kind of low right now because it's historically been around 102%. It's at 84% right now. So it's actually kind of cheap right now to buy contracts, right? So I prefer to buy longer term contracts on positions like this. Like for example, buying a year out, buying January of next year contracts, right? If you're gonna buy the equity, look at this, right? So you can buy the stock right now for 24 bucks a share roughly, right? So for every 100 shares, it's gonna be $2,400 approximately, right? Or instead, you can buy the $10 call option for $15 and change and pay almost half that amount, right? Or if you wanted to, you could pay for the 20 buck call options, which are in the money, but you're paying a lot of extrinsic value on the contracts. And then basically every month you could sell out of the money contracts against it to shave your premium down over time. So for example, let's say you bought the $10 call options on Virgin Galactic, your break even is then 10 plus, let's say 15.20, for example, it's 25.20. That's your break even price, right? And so then if you were to sell premium against your contracts every few weeks or every month or so, you might pull in, like, for example, let's see, for the next 2 weeks, you can pull in at the 27 strike, 65 cents, right? So that right away reduces your cost basis from 15.20 down to about $14.60 or so, right? Then for February OPEX, same idea. You could sell out of the money, perhaps 30 strike, for example, and pull in $1.55 or so, right? So just some ideas. Poor man's covered call may be a good idea on Virgin Galactic. Obviously, if it breaches your short strike, you're still profiting overall because you're selling above your break even. But the key is to sell above your break even price, not below it, right? Otherwise, the bigger names like Apple, Microsoft, Salesforce, Amazon, Netflix, I think those are probably safer bets for the year ahead. I think that that Apple, Microsoft, so AAPL, right? One sec. I think that Apple, Microsoft, and Salesforce will be probably better bets longer term this year. And to hedge that, I might look at hedging with Russell puts, right? So IWM puts, for example, right? But Apple's been firing on all cylinders, Microsoft too, and Salesforce as well, right? Those three names. So Apple I'm bullish on heavily into this year. I think it has potential to go to about 170 a share by end of year. And we saw it hit all-time highs this past week at 138.79. It pulled back again down to 132 and change. Next area I'm looking for is approximately the 125 area for a adding to a position, right? So you want to be cautious and again use your previous resistance areas as support areas now, right? So previous resistance was around 125. Now that will be your support area approximately, right? So looking at Apple for the year ahead, the expected move for 1 year out right now on Apple is, whoops, this is Virgin Galactic, sorry. So for a whole year out, you can see that the expected move on Apple is about 40 bucks in one direction roughly, right? So upside would be about 175, downside would be about 95, right? I think it'll tap that 175 area at some point this year. And they're just killing it with phone sales, their AirPod Max, the AirPod Pros, their Apple TV, Apple Music, the Apple Fitness now, the M1 MacBooks. Like they're just firing on all cylinders right now. Absolutely incredible execution by management. And I think that even on any kind of market pullback, it would be a great buy the dip opportunity for Apple, Microsoft, or Salesforce as well, right? So MSFT, same idea, and same with Salesforce as well too. I think I'm going to forego looking at the rest of the names today. Maybe look at actually Amazon because I do think it's still breaking out right now. I think Amazon's going to break out to the upside the next few weeks and push that 3,500 area. So obviously look at it with call spreads because earnings season kicks off in the next couple of weeks, and you're going to see some higher volatility in these names over the next 2-3 weeks, right? This week, I think the only big name reporting is Micron, and they are right at an all-time high right now as of Thursday close. And for the week ahead, the expected move on Micron is 6.8%. Upside is 80.49, downside is 70.27. And then the potential move is upside of 82.46, downside 68.30 approximately, right? So that's one idea to look at on is MU. And again, I don't recommend trading earnings because they are binary events. So I would stay away from it and maybe play it after the event itself, right? Otherwise, guys, I'll probably stop looking at tickers right here because I've already gone for about an hour now. We can do some Q&A now if you want. I'm going to cut off the recording here. So obviously, if you guys enjoy the video, then like and subscribe and share with your friends. And otherwise, I'll see you guys next week. But we'll do some Q&A right now, guys.